Hey, welcome back. I hope you had a great Memorial Day weekend. This week, we've got some inflation data to break down a little bit, and we're starting to kick off jobs week. So we'll kind of give a little bit of an insight into what we're watching there, but really dig in next Thursday. My name is Brandon Steele, financial advisor with Mainsail Financial Group. And our goal every Thursday at 3 is to bring to you the market news, the data, the trends, some of the things that we're watching, and hopefully weed out a bit of the noise along the way. Hopefully you had a great Memorial weekend. It was not very nice. So hopefully you were able to stay dry or get outside maybe during some of the dry patches. But here we are on a short week. Obviously the markets were closed on Monday, but even so, we've got a lot of data to unpack here. And our question of the week will be about tax loss harvesting, which is very relevant given the markets here so far year to date. So last week, end of the week, Friday, we had some inflation data come out. PCE inflation came out 6.3% year over year. It's the first time we've actually seen this number slow or pull back a little bit. Now, that doesn't mean inflation is going the other way. It doesn't mean prices are coming down. It just means they're not growing as fast. Okay, so make sure, like, that is a very important consideration when you're reading this headline news about the inflation rate. Obviously, with that, we saw a lot of conversation about, is inflation peaking? I mean, that day it was in the news, that was everywhere. Is inflation peaking? Inflation's peaked. All this stuff about the idea that, you know, from one data point, inflation is done. So is it true? You know, obviously we'll have to wait and see. You know, I'd love to hear your thoughts as far as whether or not this might be slowing down. I think obviously we all hope that's the case. That said, you know, I don't know that this is the end of it. And to be fair, you know, maybe peaked, right? It's possible that maybe we're at a point where we start to see that taper off to some degree, but I don't expect this to come down significantly. So even if we've peaked, I imagine we'll still be seeing continued, you know, pretty significant increases in prices for some time to come. We also saw spending up quite a bit, which was really good and kind of a carryover from what we talked about late last week. Costco earnings on top of this spending data has shown that the consumer may still be pretty strong, which is really good to see because with like Target earnings and some Walmart, some of the retail companies a couple weeks back, there was a lot of concern that the consumer, us, was slowing down a bit and maybe stopping purchasing, stopping, you know, the spending. But it was good to see that that may not necessarily be the case, or at least not yet anyways. Obviously, moving into this week, markets were closed on Monday for the holiday, and then we opened up on Tuesday with a pretty surprising consumer confidence number, much better than expected. But then we jumped straight into jobs week. So on Wednesday, we saw job openings numbers at 11.4 million. Still a very large number. It was 11.5 million last month, for those who might remember. And obviously an issue. This supply and demand issue of jobs it's a challenge for sure. And then, you know, fast forward to today, we saw ADP employment report actually very disappointing. Only 128,000 jobs added. And if you think about 11.4 million openings, that might take a while to fill, right? Now, keep in mind, this is not the best indicator of the jobs market. So coming up tomorrow, we'll be breaking down, or sorry, tomorrow is non-farm payrolls, which we'll be breaking down next Thursday, which is a little bit better of a signal as to where we're at. That said, obviously today's data was not very exciting, but we did see initial jobless claims come out at 200,000. So that was, you know, a little bit of a good signal there as well. And the markets are shrugging it off. Markets today are looking, you know, pretty good. They started down quite a bit, but ramping up quite a bit through the day. So we'll see next week. Again, we've got a lot. It's really going to be jobs week breakdown. So with non-farm payrolls tomorrow, we will talk all about that next Thursday and what that may mean for the markets coming up. And before we break, we have a very good question of the week here this week, which is all about tax loss harvesting. So when markets are down, it doesn't mean that there's nothing you can do with your portfolios. Obviously, it's hard to say you want to sell at a discount. That said, there can be some opportunities to manage the portfolios that can help your after-tax return, which may not show up on a statement, but at the end of the day, what you bring home, the cash you actually recognize, is what it's all about, right? So tax loss harvesting is a way to help you get some tax benefits during a down year. And generally what it states is if you have a position that let's just say you bought at $100 and it's now trading for 75. Normally, obviously, you may not necessarily want to sell. That said, if you do, you actually can lock in what's called a tax loss for that year. So whether it's short-term or long-term, obviously depends on when you had purchased it, but you can use that loss to either offset other gains that you might have for the year, offset some degree of income. But even if it's above that, you can actually carry that forward for years to come and offset some future gains as well. So tax loss harvesting can be a very powerful tool. Now, the challenge is you don't want to sell just to create a tax opportunity necessarily, unless there's a very, very big reason for that. But generally speaking, where you may use this is a situation where, number one, a position is maybe not needed in your portfolio anymore. It's something that you feel like is no longer of value in your portfolio. Number two, maybe a change in your goals. So maybe you are now more conservative or more aggressive or whatever the case might be, where selling that position actually helps to get you where you need to be anyways. Or ideally, number three, if none of those apply, is actually to swap it with a similar type of fund. Now, the key that I want to really point out here is when you do this, it cannot be substantially identical. So, you can't sell a stock and buy the same one the next day. That will offset this tax. They'll catch that and disallow the tax loss opportunity there. Similarly, you can't sell a fund and buy an exact replica because that will also disallow this tax loss. That said, if you can find one that's very, very similar, it may not have a huge impact at all to your overall portfolio, but by swapping it with another, similar type of fund, you can actually, maintain your portfolio composition and potentially take advantage of some tax opportunities, while the markets are down. So hopefully that is helpful. Obviously, very, very timely given what's gone on year to date. Again, I would suggest that you may not want to use this just for tax purposes, but if you can find a way to use that in a bigger strategy, it can be very impactful. And again, it won't show up on statements, but certainly drives home your total to the bank return, which is what really matters at the end of the day. So hopefully that's helpful. As always, let us know if you have a question. We'd be happy to cover it in our weekly webinars moving forward. In the meantime, have a great Thursday on this short week. We'll see you next Thursday at 3 and break down all things jobs data. Have a great upcoming weekend. We'll see you on Thursday.